we do think there is a very high likelihood that we're getting near a bottom in longer term bonds, and that rates will likely pull off. But that's more of a bounce than we think a structural bull market, because we do think there's this big picture situation with debt and fiscal issues that will provide a headwind probably for decade or two to come.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart, welcoming you back here at the end of the week. We're going to do a little bit of a wrap up of the market action this week, joined as usual by my good friends John Lodra and Mike Preston, the two senior lead partners from New Harbor Financial, one of the financial advisory firms endorsed by Wealthion. They prepared a fair amount of charts for us to dig into here. Really quickly, though, before we do, I'll talk more about this at the end, but I just want to remind folks, this interview is releasing is Friday, October 20th. Well, the next day, Saturday, October 21st, is Wealthion's online fall conference. So if you're watching this video when it gets released, you have less than 24 hours left to register for the conference if you haven't already. To go do that, go to wealthion.com/conference and hope to see you there tomorrow. Fantastic lineup. Again, I'll talk about them in more detail at the end of today's discussion. But best faculty we've ever had. Probably couldn't be more timely than any other previous conference we've ever had. So hope to see you there. John and Mike, thanks for joining us. Guys, a fair amount going on this week. John, I know you prepared some charts. How do you want to start? Do you want to start walking through the market action? Do you guys want to react to the interview with Lynn Alden the other day? Because I know that she hit some points that resonated with you guys. How do you like to begin here?
Well, we didn't really discuss this beforehand too much, Mike and I, but why don't we touch right in? I think it's always nice to finish on kind of the market action and bringing it home to what we're doing and seeing and doing for clients. The headlines have been and remain even today kind of the moves in interest rates. Many folks are well aware of this, even in their daily lives. Anybody looking for a home knows that, for example, mortgage rates have shot up dramatically. But this is all driven by what's been happening to Treasury bond yields on the longer end of the curve. We've known for better part of a year that the Fed has been aggressively hiking short-term interest rates on Treasury bills and things like that. But the longer end of the curve, 10, 20, 30-year Treasury bonds is where we've seen the most action lately. And that action has been a very pronounced spike in interest rates. And therefore, the prices of those bonds have dropped rather precipitously. And we count ourselves among the many folks in markets and investment management that have been humbled. We waited quite a while before even toe dipping into the space. I'll just share a chart here of an ETF that holds longer term Treasury bonds. This is TLT, which is 20 plus year Treasury bonds. And basically, it peaked at about 180 in early 2020. That was in the sell-off of COVID. You can see a massive drop here. This drop peak to trough. These are all monthly bars, by the way. This drop peak to trough exceeds what the stock market dropped in the housing crisis. So it's a very profound drop. We started buying somewhere in this range, really for a shorter term tactical trade, because we did and continue to see structural issues as a hangover of over a decade of massive distortions by quantitative easing and things like that. But here we've had a dramatic further sell-off, and that's because yields have risen. We got a bounce earlier in the last week or so, maybe a flight to safety trade, a little oversold bounce. But here we are today testing new lows on that. 10-year Treasury bonds have spiked above 4.9, at least briefly. So our discipline, of course, is we do acknowledge and adhere to buying things when they're oversold or considering them to be bought. And we had a very oversold nature here. These are, 2 standard deviations, this purple line, 2 standard deviations around a daily moving average. So, anytime you get something punching below that, there's a probability that you get a quick snapback. And we did, in fact, see that here, but it's rolled over. But I think just to tie this bigger picture, there has been, again, I think the real thing we need to focus on is not the recent spike, but really the distortion that we've seen over the last decade. And, I think sharing and Lynn Alden spoke about this tremendously, I think, in the interview you did with her this week. We have a kind of an inflection point here. There is a tipping point, perhaps, in terms of total debt outstanding at what are now much higher interest rates than even a year ago. And you're looking at foreign governments buying less of our debt, defending their own currency. There is a bit of a tectonic shift in the landscape here. And I'll bring a couple of charts just to bring that home, and then we'll kind of pause, and I'm sure we've got plenty to talk about there. But let me just pull a couple of charts in to drive that point home. So this chart, hopefully you can see, is just basically stating what everybody probably knows, but it's always eye-popping for me to look at in a picture. Basically, it just shows the pace at which our total debt, has outpaced GDP. This is actually a little stale because it's quarterly. We're over 33 trillion now, and over total outstanding debt. So that's like a household really spending recklessly, and there's no end in sight from our eyes. In fact, the projections for budget deficits and debt issuance are pretty stark. I want to kind of go on and look at a couple of the charts to tie this in. So this is a chart right from the Federal Reserve's website, and it basically shows two things. First of all, this blue line, and this is measured on this left axis. It shows the percentage of total U.S. public debt as a percentage of GDP. I'm sorry, the red line is on the left. That's total percentage of debt as a percent of GDP. Here we are plodding around about 40%, got as high as, above 60% in the 90s. And then boom, we had a step change here in the wake of the housing crisis, and then boom, in the wake of the COVID crisis. So we are now firmly over 100% debt to GDP. That is not good. and the end does not look like it's in sight in terms of how high that can go in the near term. The blue line is actually measured on the right scale, and that basically is the interest expense on that debt incurred by our government as a percentage of GDP, and that again is on the right scale. So in the 70s and 80s, when interest rates were really high, that was 3% GDP, higher than today. We're not quite 2%, but the big difference here is the total amount of debt outstanding was a fraction, about half of what it got to here. So I'm going to tie that all together with one final chart that our one of our heroes, John Hussman, put out in his weekly commentary this week. And this basically shows, in looking at the total situation, interest rate plus total debt, he kind of, presents this in a kind of a hypothetical but very helpful construct. It basically shows the burden as if this were a mortgage, and what would the mortgage payment look like as a percent of GDP. So you combine, a spike in yields with an absolute massive spike in total debt outstanding, and you see that whether you amortize it over 10 years or 30 years, there's a massive spike in the total debt burden plus interest rate as interest expense as a percent of GDP. So I think that is it ties into a lot of what Lynn Alden had talked about. Basically we have a situation where, probably similar to the 40s, where coming off a decade now, we just had, monetary policy dominance, all these experimental policies driving monetary, rates down to zero. And suddenly we're in a situation where we're seemingly seeing a period of fiscal dominance, where spending and debt and all that stuff overwhelms what the central bank can and maybe wants to do. And that is very similar to in Lynn Alden's example, the 40s, maybe even more so than the 70s. So we're, all to say is, we do think there is a very high likelihood that we're getting near a bottom in longer term bonds, and that rates will likely pull off. But that's more of a bounce than we think a structural bull market, because we do think there's this big picture situation with debt and fiscal issues that will provide a headwind probably for decade or two to come, unlike the last 4 decades, which has been a massive tailwind for stocks. So for bonds. So I'll pause there. It's a long-winded diatribe there, but appreciate the patience.
No, very useful. And that chart by Hussman did a really good job of showing how things are really starting to kind of get out of control, right? The 2023 part of that chart was in record territory, and the trajectory was steeply still going higher, right? And one important thing to know about government debt, just like corporate debt right now, is that a lot of what's still outstanding is at low interest rates. And so as those mature, they're going to re-rate at much higher rates as long as rates continue to stay high, right? So that spike that we're seeing there at the end in 2023 should start leaping even higher in magnitude as more and more government debt comes up for maturity here. It'll be a different story if and when, rates start coming down again, but there's no daylight on the horizon yet for that. So big issue. And as Lynn said, to your point there about shifting from an era of sort of monetary dominance to fiscal dominance, as that debt, the cost of that debt, the debt pile grows and it's growing by leaps and bounds, as you said, as the cost of that debt becomes more expensive, which it's become tremendously more expensive, interest rate wise over the past year. That leaves a bigger and bigger hole in the federal budget, right? Because the interest expense on the federal debt gets bigger and bigger, starts crowding everything out. And so the only response that politicians are going to pursue, right? They've got two choices, right? Which is basically do less, right? Or they've got to just basically spend the difference. And that's what we're doing right now, right? That's why we have these massive fiscal deficits. And when I asked Lynn about this kind of battle we're seeing right now between, the monetary side trying to pump the brakes and the fiscal side trying to hit the accelerator, she was very confident in saying that she thinks the fiscal side is going to win that battle, which just means more and greater deficits, for the greater future. That's how they're going to deal with this growing debt pile. You're nodding as I'm saying all this, John.
Yep, no one knows for sure, but there's a lot of signs that that's kind of what's playing out here.
Okay. So John, you said that, given that outlook, which is, it's a present outlook, but it's really kind of a longer term trend that we're talking about. I think that's what you're referring to when you're talking about, an era of headwinds in front of us. But it does sound like, in a secular trend, you can have lots of different cycles, right? Yep. And it sounds like you were saying in the bond market, you guys think that we are at a peak in terms of pricing and rates here, cycle-wise, and that you expect, some relief coming forward, and that's why you're continuing to remain in the longer bond trade here, the TLT trade. Am I getting all that right?
Yeah, absolutely. We think there's probably going to be many tradable movements in the bond market over the coming years versus the last 40 years. You basically just bought and held bonds and interest rates basically steadily declined and was, probably a once in a generation bull market in bonds. We think a total different picture lies ahead. And yeah, we think the near term yields are probably close to peaking, if not have already. A few weeks ago, we said maybe the 10-year gets to 5.25 in an extreme scenario. We're close to 5 right now. And so we think we're in the vicinity of a near term peak in interest rates and therefore, pretty decent viable area here for bonds. There are enough vagaries here that we wouldn't say load up on 50-60% bonds right now. We have a 15 to the 7.5% to 15% position, of which we have half hedged for the folks that have a larger position. So we're very comfortable with the position for where we are right now. But there's enough vagaries here that we don't think moving to a 50 or 60% bond position makes a whole lot of sense right now.
Okay. All right, Mike, coming over to you now. I guess first, do you have anything to add to the Lynn discussion above and beyond John's comments?
Yeah, I guess just as a quick maybe outline of what I'd like to chat about here, Adam, I'd like to make a few comments about Lynn Alden's talk, and her talk was great. Then share a chart on Treasury bill and Treasury bond rates. Just take a quick look at the yield curve. We get a lot of questions specifically about where exactly should, where should I put my cash? What type of bond should I buy? I can answer that in this video. And then just take a quick look at the charts of both the S&P and of gold. Gold has been making what I think is a stealth move lately. So those are the things I'd like to talk about, and start with Lynn Alden if I can.
Go for it.
So the things that I like that Lynn said, and I like everything that Lynn says. I really like the fact that she's so analytical and technically based, yet she sees the big picture in an abstract way. Like I think that that we talk about here a lot of times.
Yeah, and I know you guys like her because Lynn has an engineering background, and
Yeah.
and you, John, were engineers before you became financial advisors, correct?
Yeah, I think that's probably why we resonate with her, because we've got the same type of mind. She's very intelligent. Um, and I'm just looking at my notes here. The things that I wrote down that I really liked that she said. She talked about the fourth turning. We're in the middle of the fourth turning. Frankly, we're probably past the 50% point of the fourth turning. We have 5 or 10 years left in this fourth turning, and these are climactic times of maximum risk and change. And she says that major debt cycle inflection points have coincided in history with fourth turning climaxes. Obviously it makes sense. The Fed and every other central bank in the world is throwing everything in that they can, including the kitchen sink, with no other plan. And so we're all kind of marching towards this climax. We don't exactly know what it is, but she said when you're vulnerable, you're more likely to have bad things happen to you. The things that you just showed, the chart that John showed, showing the debt going absolutely vertical post 2013 is not sustainable, and it makes us more vulnerable. Particularly as we start to get, as you said, bond maturities, reinvesting those bonds at higher rates. The cost of the total debt goes up and up and up. All of this is kind of coming together in what is likely to be a climax of the fourth turning. We don't know exactly when or where, but we do know the basic math that things are not sustainable. And so therefore, particularly in a time when there is an alternative, there's other things to invest in besides taking a lot of risk. So, Lynn talked about the bond market. She's less bearish now than she was a year ago, probably because of the collapse, or maybe even less bearish than she was 6 months ago. We are not raging bulls on the bond market, but we think that we've seen an absolute capitulation in the bond market the last couple of weeks. I don't know exactly where the bottom's going to be or where the high end yields are going to be. We're almost at 5% on the 10-year bond. Maybe we touch it, maybe we don't. But we like bonds up to about 15%, maybe 20% max if somebody really has a high risk tolerance in longer term bonds. And Treasury inflation protected securities are looking better. Lynn says this as well. We were looking in our investment committee meeting over the last week or so. We were noticing that 5-6 year tips are up to I think 2.5 or 2 and change percent real return over 5 years. This is substantial. So nibbling on those could be a decent idea. We tend to agree with her on that.
Yeah, and sorry to interrupt there, Mike, but I've had a number of people on this channel recently talk about the relative attractiveness of tips. I think Victor Hagani, the guy who actually used to work for long-term capital management, said that they're one of the best things that he sees on the horizon right now.
It's hard to deny, right? You got a real yield approaching 3% over 5 years. That's a whole lot different than what we were looking at just a couple of years ago. With flat to negative real returns across the board. And don't forget that with these valuations, the S&P 500 or the Dow or the NASDAQ, whatever index you want to pick, almost certainly will return negative returns annually from here over the next decade. We often show charts from John Hussman. I think John has some others that he may show later in the video, and there's a lot of other sources too, besides just Hussman's work, that pretty much proves in our view that from these levels, there's no positive return. There's no nominal return either over the next 10 years. So when you see real returns that are rock solid guarantee, they start to look attractive. Lynn also says, she's bullish on gold and Bitcoin, negative on equities. I just said that we are too, and said, Treasury bills as well. Treasury bills. Our model is about half in Treasury bills right now. This is probably a good segue into this particular chart I'd like to show. If you just give me a minute to get it up here. So, there is an alternative. This is the Treasury yield curve. It's still inverted. If you look down here, this is the maturity. So the 1 month Treasury is 5.5 and change. And there's actually slightly increasing here between 1 month and about 4 to 6 months. The sweet spot in the short end right now is right about 4 months. We actually just bought the 4 month bill today we have a a model which is Treasury bill only. That's for people that want to park cash. We can just roll Treasury bills for them. And we when we look at buying new ones, we don't automatically buy ones that are 1 month out. Right now, we grab the 4 months. So anyone out there that's rolling T-bills on their own, I know it's not a big difference, but right now the four month is the sweet spot. And you can see that the yield goes down as you go out from there. Not a lot. The 2 year, if you look here, is still at 5.2, almost 5.2. So we're still above 5% on the 2 year. And so, really, if you don't need the money in the next couple of years, you could really just pick anywhere in here. But I would probably be buying, some 4 month and maybe a bigger chunk in 2 year, just if you don't need the money soon, just because short rates could come down quickly at any moment.
And then, sorry for interrupting your Mike, but I just feel compelled to repeat myself to what I said last week, which is I just remember during 2022, right, when the markets were correcting both stocks and bonds, where I lost count of the amount of people that came to me and said, I just want a place where I can get a 4% return on my money, a dependable 4% return. If I could get that for the rest of time, I would be thrilled, right? And they were, looking around nervously because almost all assets were coming down at that point in time. And they were kind of just begging me, can you just point me to some sort of instrument where I could get a 4% return, for the rest of time? And I just want to point out right now that those prayers have been answered. You can get a long US Treasury now for, getting close to 5%. Up to you and your financial advisor whether that's the right move for you and how much of your portfolio should be in that. But just want to point out that people were begging for this a year ago. Now here it is.
Absolutely. And while there's certainly risk going out further, take a look at the long end of this curve. Yes, it's still inverted in that the 30-year is yielding roughly, it looks like 0.65 or 0.7 less than the front end of the curve. That's what's called an inverted yield curve. It's a sign of a sick market/economy that will probably uninvert at some point. It certainly will uninvert. It always does. We just don't know when. But on the long end, past 10 years, take a look at this little knee right here. This little hump right at the 20-year. So if you don't have any longer term US Treasury exposure, and you're buying individual treasuries, you might consider the 20-year Treasury, or you can buy something like the ETF TLT, which has a whole bunch of individual bonds. I think it's like 37 bonds last time I looked, that has a maturity right around 20. But here, there's a nice spot at the 20-year where you're at about 5.12% or something. So yeah, absolutely, it's very attractive. So I'll stop there and pause, and I'd like to come back and maybe just talk about the stock market and the gold market later.
Okay. Well, look, John, we'll ping pong back to you. I know Mike mentioned some charts you may have from Hussman talking about expected future returns in the markets. Don't know if you want to go there next or not, but we'll ping pong back to you, and then we'll go back to you, Mike, and then I'll start wrapping up because we got to get ready for tomorrow's conference.
Yeah, sure. We might as well show these charts from Hussman, and we're borrowing heavily. He put out his monthly commentary this week, so it's chock full of great perspective. It's all data, not his opinion. It's actually black and white data. So we're very, very big fans of his work. And he got a great shout out about a week ago from Jeremy Grantham of GMO. Jeremy Grantham put out a great podcast. It was on Spotify. I forget, it was recorded. I think it broadcast in the UK. I think where he's originally from. But he had a great podcast, and he did give a great nod to. In fact, he said Mr. Hussman puts out the best work out there in terms of the historical exploration of valuation levels and subsequent returns as a predictive variable for future returns. And this next chart speaks to that. So I'll share that.
Hey, John, just while you're bringing it up, I just want to let folks know. So we are all fans of John Hussman. We actually all met John together years ago out in my neck of the woods for a conference that ended with us all sitting around the fire with John while he pulled out his guitar. He's a great guitarist. But John and Jeremy Grantham are actually quite good friends. They have a lot of professional respect for each other, but I think they also have a pretty good relationship. I'm bringing this up because I've mentioned to John that if he ever wanted to get in the same place with Jeremy, either physically or virtually, to have a discussion, that Wealthion would absolutely underwrite that meeting of the minds and would love to film it and bring our whole audience along for the ride. So folks, if that would be of interest to you, let me know in the comments section below. I keep pinging John about it from time to time, but I can go ping harder if there's enough interest.
Oh, that would be a fabulous get together if you get the two of them together, Adam. And yeah, we did have quite an enjoyable song jam session around the fireplace with John several years ago. So I appreciate you raising that. So let me share this chart. Basically this chart, and this is all actual data. It's not anybody's forecast or opinion. And it goes back to 1928. And it basically looks at, again, referring to Grantham's nod to Hussman, one of the valuation metrics that he's done a lot of work on is this ratio called non-financial market cap over gross value added. Cutting to the chase, it's a much more statistically reliable metric than almost any other valuation metric in terms of its statistical correlation with actual future returns. If you go back and look at history from 1928 to 23, about a 93% correlation, I think, which is about as good as you get in the stats world. And that's evidenced by this scatter plot. When you see a scatter plot that is this tightly wrapped around a 45-degree line, that's a pretty good statistical measure. So basically, it shows on this axis, the higher this valuation metric gets, the lower the actual subsequent 12-year returns in the S&P has been. And so for example, if you look at where we are right now, this historical relationship success suggests that we'd see nearly a negative 4% annual return from these current levels held passively over the next 12 years. Now, John is also very careful to point out this isn't a forecast. And in fact, basically, if we don't get back to what you might call normal valuations, this forecast would be unduly harsh. But it also means the forward projected returns shouldn't be, for example, 10% annual expectation, like many people are destined to believe they're going to achieve. In fact, you can use this same chart and say, okay, if we assume 10% annual returns, history would suggest that would be consistent with a valuation metric of about 1.0, which is, I think about 60+% below where we currently are. So that's a very tight historical relationship.
Right. That's an S&P with a 2 handle on it, right?
Exactly. It's around 2000, give or take, maybe a little below 2000. So
actually, you're right. It would be below 2000 if it was 60%. Yeah.
So that's all predicated us coming back to what you might consider normal valuations. It's entirely possible that we don't, but you also shouldn't expect very good forward returns. You should expect very dismal returns if we don't fall back to that. And I just want to tie it together with one other chart here, because this brings into the comparative of stocks and bonds. So this chart, again, a scatter plot, which is pretty tightly scattered around this 45-degree line, basically shows the estimated 10-year excess return of the S&P 500 in excess of Treasury bonds. In other words, how much do we predict? Does this model predict stocks will exceed Treasury bond returns? And in fact, and this is the actual experience of 10-year versus Treasury bonds. So right now, this is projecting that stocks will underperform Treasury bonds by about 6.5% over the next decade. That's pretty stark, but it really just another way of saying how overvalued the stock market is. So the bond market has repriced in a very meaningful way for these higher interest rates. Our contention is that the stock market has barely wakened up to that reality yet. And this is not so much a statement that you should be loading up on bonds with reckless abandon. To us, it's a challenge to, if you think about the typical 60-40 portfolio, we think both the stock and bond components of that should be significantly underweighted, but especially the stock part. But
especially the stock side.
Bullish about bonds, should at the same breath be very cautious about stocks because of this historical relationship.
Super important. So John, do me a favor, just for the non-mathy oriented, just head back to the previous chart for a second.
Sure.
So this is just saying that prices have reached such high levels of valuation that according to this model, which is built from all this historical data, suggests that for the next 12 years, the market should return on average a negative 4% return, right? So, more than a lost decade in the stock market. Now, of course, it's probably not going to do that consistently. You're probably going to have some big up years, some big down years, but the net effect will be as if the market declined 4% a year each year for the next 12 years.
Why is that? It's because valuations are, on this metric, have only been seen this extreme twice in the very long history here, 1929 and the very top of the tech bubble peak. We're even far eclipsing where we were in 2007 before the over 60% peak to trough decline in the stock market during the housing bust. So as absurd as this sounds, that's exactly what happens, or historically anyways, when you get to absurd valuation levels.
Great. So this chart is just a huge blinking warning signal that says stocks are way too overvalued and they may correct. The second chart you had there was basically saying that to a certain extent, bonds have corrected. So from a risk return basis, they're probably much more attractive right now. Do they have further down to go? Maybe that's a different discussion. But it's definitely saying relative to bonds, stocks are super overvalued. And so if you, again, have a blended portfolio, if you're going to be lightening up on something, you really should be looking to lighten up on stocks first, given this high level of overvaluation. Okay, you're nodding as I'm saying all this.
That's exactly what that data would suggest and tell you.
Okay, great. All right, Mike, I'm going to bring it back to you to wrap things up before I give the details of the conference, and then we'll start getting ready to spend something like 10 hours straight together on Zoom tomorrow for the live event.
All right, great, Adam. I'm going to keep it pretty short here because, as you say, we've got a lot to do, and we're going to be talking all day on Saturday, which is tomorrow by the time this comes out. But here's a daily chart of the S&P. I just wanted to give people an idea of what we're seeing right now. It is still very much a mixed bag. This is a daily chart of the S&P. And, if I back up just a little bit to the weekly chart, we had this relatively tame decline last year, followed by really just a straight up 45-degree bounce from October of last year. But we are not above the high that we saw on January 4th, 2022, 4818.62. We came within about 78 or 80%, I think, maybe a little bit more Fibonacci retracement. And then since then, it's been a few weeks down, couple weeks up, few weeks down, couple weeks up. So this has been lower lows, lower highs since July. So July 24th. And here we are, October 20th, I guess, as of when this airs. I mean, basically 3 months later, and the market is down. I mean, everyone is still asleep. This market has not taken out the high almost 2 years ago now. It's been a very thin market this whole year, only 7 stocks. In fact, let me change the symbol a little bit. Here's the equal weighted S&P 500, basically flat on the year. Here's the Russell 2000, flat on the year. It's really just the S&P. The S&P is up, 10, 11%. And here, again, is the weekly bounce. The last 3 weeks, relatively weak bounce, but it's hanging in there. I move back to the daily. Here's the head and shoulders top that we keep talking about on the daily. The left shoulder, the head, 2 right shoulders. We broke through the neckline, which in my opinion is this line right here. We went down for about 2 weeks. We recovered back to the line, and here we are, just sitting here between the 50, which is the red line, and the 200-day moving average. And then our own indicators are a mixed bag. Our shorter indicators are reversing to the upside, telling us that if we break out of this consolidation, we could be in for a bullish ride for a few weeks or a few months. But it's really a mixed bag. If we break down here, I think we're coming right down to 4,100 and then more. That would be the short-term target, 4,100. So, be cautious. We're nibbling on a couple hedged ideas here and there, but by and large, our equity exposure is still quite low, and we're very well hedged, and we have close to 50% cash equivalent. So that's the S&P. Let's see what the rest of this week and next week brings. And then lastly, I'd like to just close with gold. I'll use GLD as a proxy. Gold, this is a daily chart, is up on the year a little bit. It looks to be up around almost $100 on the year. It had this disappointing breakdown on the daily chart, and then we just kind of went vertically here the last couple of weeks. I don't know if it's because of the things that are going on in the Middle East, but it's had this kind of stealth move all while the dollar has been getting stronger. Let me move out a little bit. Move out to the weekly, or actually even the monthly chart. Let's just talk about it in the big picture. Now, here's gold on the monthly chart. Big consolidation over 11 years. Sideways movement here, 1, 2, 3 tops. We keep talking about it. We think that the triple top will be taken out. And look what happened here. Last month, we had a breakdown, but it was a fake out. We've immediately reversed it this next month. And I believe if we go a little higher, spot gold is like, higher than this right now, close to 1950 or so. This happens to be GLD. But we go a little bit higher here, we're going to be knocking on the door of these triple tops. And if that happens, once we break through there, we should go right up to around 2,500. If you take a look at what's happening to the dollar during that same time, take a look at the dollar on a monthly chart. We're almost back to the old high. And for gold to be knocking on the door of the upside, or the peak, or the roof of that triple top while the dollar's been getting stronger, I think is really, really bullish, and not a lot of people are talking about it yet. So I think it's a good sign. We'll see.
I think it's really good to note here, right? Which is historically higher dollar and higher yields generally tend to pull gold lower, and with gold performing, hanging in there as much as it is, with those two, very substantial headwinds, it begs the question, well, gosh, if the dollar hits a period high and starts weakening, and obviously if yields start coming down, will that switch that headwind into a tailwind for gold? And if gold's near its all-time highs when that tailwind starts to kick in, well, where does it take it from there? But arguably, likely substantially higher.
Exactly how we look at it.
All right.
Said it perfectly.
Well, look, I'm going to tease you guys here a little bit. So I just recorded Tom McClellan's section for tomorrow's conference. Tom McClellan, one of the most respected technical analysts alive today. His family is the developer of the McClellan oscillator. Tom is great. And I know you guys saw the previous interview that I did with Tom. So you know what a great explainer he is. But he's got a number of charts that are just spooky in their level of correlation to one another. And basically what he likes to do is he likes to look at these highly correlated data series where the correlation shows up when you time shift them. So you'll find you have these assets that lead other assets by months or quarters, or in some cases years. And like I said, the correlation is super spooky. So you can see something that an asset did a year or two ago that basically predicts how the other asset is going to perform 2 years later, right? So he's got some charts about the stock market itself, and let me tease you all by saying this. He says that 2024 basically is the year that the wheels come off, right? And his charts tell him when in 2024 that's going to happen. I'm not going to share that detail here because I want folks to go and see that itself at the conference. But I will give a quick nod, guys, where his chart shows that the market's probably not going to roll over this year, according to his indicators. Of course, anything's possible, but he's much more prepared for that rollover moment to happen in 2024. And again, like I said, he's got a very strong sense of when it's going to be. If you're curious to find out, watch the conference tomorrow. All right, guys. Well, look, thanks so much, John and Mike. For everybody else watching, again, please, if you're thinking about coming to the conference, register now, because you literally only have hours to do so. Very quickly, let me just summarize the faculty that we have there. It's really the best we've ever had for one of these events. It'll be kicked off by Lacey Hunt with his keynote, just packed with Lacey's famous charts. If you've watched one of our conferences before, you know that Lacey's opening remarks are worth the entire price of the conference in and of themselves. After he presents, he's then going to come on for live Q&A. So you, the audience, will be able to ask him whatever questions you want to. He'll be followed by James Grant, who's going to talk about where he sees interest rates headed from here. Michael Kantrowitz is going to come and present on his HOPE framework, which tracks how we fall into recession. So he'll be telling us where we are on that timeline. And you can bet we're going to be doing a deep, deep dive on the E part of that HOPE framework, which really is the last remaining bulwark between us and recession, the employment market. So we'll go deep into Michael's data around that. Kyle Bass is going to talk about our top geopolitical trends that are likely to affect the global economy next year. And of course, that's even more important of a topic now that we've had these recent tragic events in the Middle East. Ivy Zellman will be talking about the housing market. She is substantially more pessimistic on it than I've ever seen her before. Once she's done, we're going to have Melody Wright, housing analysts Melody Wright and Amy Nixon come on, and they'll take all of your questions about housing. We'll have Tom McClellan, like I talk about, giving his full technical analyst outlook about where he sees markets headed. We'll have Stephanie Pomboy. She'll be talking about how the forces of inflation and deflation are likely to resolve next year. Mike Leibowitz is going to be on, going to do a super deep dive into the bond market. He'll then come back on, answer any questions you guys have about bonds. Then we'll walk into energy, and we'll have Doomberg talk about kind of the global energy dynamics that are going on right now. And then we'll hand the baton to Justin Hune, who will talk specifically about opportunities for investing in nuclear. Nuclear energy is a huge part of the mix, as Doomberg is going to make in his presentation, but then Justin will actually tell you how to take actionable steps on it. We'll also have famed natural resource investor Rick Rule there. And Rick just gives, I've lost track of how many dozen specific companies that he names that are on his preferred list. So if you're looking for individual companies to go out and consider, Rick gives you probably more than you're going to be able to take. And then obviously throughout the day, we'll be joined by John and Mike, the team there at New Harbor. We will end the day, as we usually do with these conferences, with live Q&A, an hour of just Ask Anything live Q&A, where the audience can ask whatever they want of our endorsed financial advisors. So that's John and Mike, that's Lance from RIA, that's Jonathan Wellham from Rocklink up there in Canada. And if there's any time left over, I'm going to see if I can't pull in Craig Wishner, Managing Director of Farmland LP, to give us an update on farmland as an investment class. And I know that's a topic a lot of people have been asking for. So it's a jam-packed schedule, but if we're able to shoehorn in, we will. Lastly, everybody who registers, whether you watch or not, one, you'll get all the replay videos of everything I just mentioned, but you'll also get a bonus video from Jeff Clark, where he'll be detailing out his latest top picks for the precious metals mining companies that are burning most brightly in a positive way on his radar. So that's a big mouthful. Everybody, it's going to be an amazing day tomorrow. For those of you that are already registered, can't wait to see you there. If you just are one of the procrastinators who haven't taken action yet, well, you only got a couple more hours left, so go do it. To go register and get your ticket, go to wealthion.com/conference. All right, John and Mike, thanks so much for hanging in there, buddies. Look forward to seeing you guys next week. Everybody else, look forward to seeing you at the conference.
Thank you so much, Adam. Looking forward to Saturday. We always get a huge amount of learning, even us who are plugged into this all day and night in our daily life. So looking forward to seeing you.
Yeah, we look forward to seeing you tomorrow, Adam, with both you and all your attendees and your special guests. So thank you very much.
All right, guys, take care. If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.